Welcome. Let us continue preparing you to pass the Securities Industry Essentials SIE exam. This video will examine additional types of packaged products, alternative investments, such as exchange-traded funds, ETFs, hedge funds, and real estate investment trusts, REITs. The final section of this segment will describe direct participation programs, DPPs, which are fairly complicated products that offer several unique tax benefits. SIE candidates should place special emphasis on the mechanics of these products, as well as on the appropriate client disclosures and tax treatments. Other types of investment companies. Mutual funds are by far the most common type of investment company. However, their shares may only be purchased or sold at the end of the trading day. For investors who want the ability to trade packaged products throughout the day, exchange-traded funds, ETFs, are available. Exchange-traded funds, ETFs. ETFs issue shares that represent an interest in an underlying basket of securities that typically mirrors a specific index. Some of the indexes to which ETFs are linked represent the securities of a particular country or industry. Some ETF examples include SPDRs, SPDRs, which track the S&P 500 index, QQQs, Cubes, which track the NASDAQ 100 index, DIA, Diamonds, which tracks the Dow Jones Industrial Average. Passive versus active management. Active management refers to the selection of securities in a portfolio by a professional manager. The ultimate goal of the manager is to outperform the market. On the other hand, passive management involves simply attempting to match the market by tracking an index. Fee considerations. The fees associated with passive management are lower than the costs added for the selection of securities in an actively managed portfolio. Unlike purchasers of mutual fund shares who may be assessed sales charges, purchasers of ETF shares pay commissions on their transactions. How ETFs differ from mutual funds. Unlike mutual funds, ETFs trade on an exchange and have prices that are determined continuously by the forces of supply and demand. Additionally, ETFs often have lower expenses than mutual funds, and their shares may be sold short and purchased on margin. Recently, specific types of ETFs, inverse and leveraged ETFs, have become popular among sophisticated investors. The value of inverse ETFs should increase when the market drops or decrease when the market rises. Leveraged ETFs seek to provide investors with a multiple of the return of a benchmark index. Inverse ETF. An inverse ETF is designed to perform inversely to the index being tracked. This reverse tracking is accomplished by short selling the underlying investments in the index or through other advanced strategies using futures and derivatives. The goal of an inverse ETF is to provide a return equivalent to short selling the stocks in the index. For example, if the S&P 500 index falls by 1.5% on a given day, the inverse ETF should rise by approximately 1.5%. These products are often used by investors with long positions as a hedge against a bear market. Leveraged ETF. Leveraged ETFs are products that use debt instruments or financial derivatives such as swaps, futures, and options to amplify the returns of a specific index. These leveraged products may be designed to either track the specified index or its inverse. For example, a leveraged long ETF may be intended to deliver 2 times or 3 times the performance of the S&P 500, referred to as double long or triple long ETFs. Conversely, a leveraged bear ETF may aim to deliver the inverse of 2 times or 3 times the performance of the S&P 500, referred to as double short or triple short ETFs. Inverse and leveraged ETFs are short-term investment products. Most inverse and leveraged ETFs reset their portfolios daily to meet their objectives. In other words, all price movements are calculated on a percentage basis for that day only, and the process starts anew the following day. Due to this daily resetting process, an inverse or leveraged ETF's performance may not provide a true tracking of the underlying index or benchmark over longer periods. For this reason, both leveraged ETFs and inverse ETFs are generally only suitable for short-term trading purposes. Exchange-traded notes, ETNs. ETNs are a type of unsecured debt security that pays a return linked to an underlying market index or other benchmark. Like ETFs, ETNs trade on exchanges and are available in both inverse and leveraged varieties. These hybrid versions are designed as short-term trading vehicles. Return. ETNs differ from traditional bonds since they do not typically make interest payments. Instead, ETNs pay the holder an amount based on the performance of an underlying index or benchmark. The maturities of ETNs can range from 10 to 30 years. Issuer credit risk. ETNs are created by a bank or other financial intermediary and are unsecured debt obligations of the issuer. Since an ETN is a debt obligation of the issuer and backed only by the issuer's full faith and credit, the issuer's credit quality is a risk factor to consider when deciding whether to invest in an ETN. Fee considerations. There are two types of costs associated with ETNs. First, there are recurring costs, such as fees included in the reference index or benchmark, as well as daily investor fees. That will lower the indicative closing value of the ETN. The term indicative value refers to the benchmark's value minus the daily investor fee. The other cost is the brokerage commissions that investors may incur when buying and/or selling ETNs. Other types of packaged products, hedge funds. Hedge funds are private investment pools that are not required to register with the SEC under the Investment Company Act of 1940. These investments are often sold under a Regulation D, private placement exemption, and their purchasers are typically institutional and high net worth investors who understand the unique risks associated with these products, such as their lack of liquidity and potential leverage employed by the fund managers. These funds typically have high minimum initial investment requirements, often $1 million or greater, unregulated. Since hedge fund offerings are generally limited to accredited investors, these products qualify for exemptions from the federal regulations governing short selling, use of derivatives, leverage, fee structures, and the investment's liquidity. Due to these exemptions, hedge funds may adopt strategies that are prohibited for more heavily regulated investment entities, for example, mutual funds. Ultimately, hedge funds are more complex and may expose investors to many different types of investment risk. Illiquid. Unlike mutual funds, hedge funds are not required to publish their net asset value daily and impose restrictions on withdrawals, which makes these assets less liquid. Since hedge funds do not provide investors the ability to redeem at the NAV on a daily basis, these products are unsuitable for investors seeking liquidity. In addition, most hedge funds raise capital by offering investors limited partnership units, described later in the video, further limiting their liquidity. Compensation. Mutual funds cannot assess a sales charge that exceeds 8.5% of the fund's public offering price. However, hedge funds often impose higher and more complex fees. One typical arrangement is a 2 and 20 fee, which involves a hedge fund manager charging a 2% management fee and then taking 20% of any profits. Private equity funds. Hedge funds often attempt to amplify investment results while engaging in the trading of existing securities. Traditionally, the role of raising capital for startup businesses was filled by private equity, PE, and venture capital, VC funds. In many ways, these types of funds are similar to hedge funds, especially due to their lack of regulation and liquidity, unregulated and illiquid. Similar to hedge funds, PE and VC funds raise capital by offering investors limited partnership units that are sold as private placements under the Regulation D exemption. For that reason, hedge funds are normally available to accredited investors only. These funds are not regulated under the Investment Company Act of 1940 and have no active trading venues. Real Estate Investment Trusts, REITs, regulation. Although real estate investment trusts have some features that are similar to investment companies, these products are not categorized under the Investment Company Act of 1940. However, the Securities Act of 1933 regulates REITs as securities and requires that prospectuses be sent to any investors who purchase shares offered to the public in the primary market. Investment attributes. REITs create a portfolio of real estate investments from which investors may earn profits. REITs invest in many different types of residential and commercial income-producing real estate, such as apartment buildings, shopping centers, office complexes, storage facilities, hospitals, and nursing homes. Income is received from the rental payments made by tenants leasing the real estate owned by the REIT. These investments are suitable for both retail and institutional investors. The three types of REITs are: 1. Mortgage REITs. Mortgage REITs provide funding to real estate purchasers by acting in the same capacity as a bank. They borrow funds from investors and then invest these funds in mortgages, typically earning income based on the difference between these two rates of interest, referred to as the spread. 2. Equity REITs. Equity REITs own and operate income-producing real estate such as apartment buildings, commercial property, shopping malls, vacation resorts, and other retail properties. 3. Hybrid REITs. These business structures combine mortgage REITs and equity REITs. By purchasing a hybrid REIT, investors can benefit from a security that invests in the actual equity ownership of real estate, as well as in an interest rate-sensitive security. Liquidity. There are 3 varieties of REITs. The first are those that are sold under Regulation D as private placements and not registered with the SEC. The other 2 are registered and are either listed or non-traded, unlisted. Most REITs are exchange-listed, traded each business day, and are reported on customer account statements at their current market value per share. On the other hand, private REITs and non-traded REITs are illiquid and are as difficult to price as hedge fund or limited partnership investments. These non-traded REITs are reported on customer account statements at their estimated market value per share. Tax treatment of REITs. The benefit of qualifying as a REIT is the favorable tax treatment provided under the Internal Revenue Code. Unlike other corporations, there is no double taxation on the dividends that a REIT pays to its shareholders. If 90% of the ordinary income generated from the portfolio is distributed to investors, the income will only be taxed once at the investors' levels. The REIT avoids paying taxes on distributed income in substantially the same manner as a regulated investment company. However, unlike DPPs, REITs do not pass through operating losses. To qualify for the special tax treatment, a REIT must satisfy the following 3 income tests. 1. At least 95% of its gross income must be derived from dividends, interest, and rents from real property. 2. At least 75% of its gross income must be derived from real property income, for example, rents or interest. 3. No more than 30% of its gross income may be derived from the sale or disposition of stock or securities that have been held for less than 12 months. Tax treatment for the investor. Real estate investment trusts offer investors a stable dividend based on the income they receive, and most investors purchase these securities for this reason. The dividends that REITs pay to their shareholders do not qualify for the reduced 20% tax rate provided to dividend distributions paid on common and preferred stock. Instead, dividends received by REIT investors are taxed as ordinary income. However, based on the 2018 tax reforms, the following additional benefits are provided. 20% of the income distributed by REITs is deductible, excluded from tax. The maximum tax rate on ordinary income has been lowered to 37% from 39.6%. Direct participation programs, DPPs. A direct participation program is a type of investment in which the results of the business venture, cash flow, profits, and losses directly flow through to the investors. Although DPPs come in different forms, such as general partnerships, joint ventures, limited liability companies, LLCs, and subchapter S corporations, this program will focus on limited partnerships. To establish a limited partnership, the partnership files a certificate of limited partnership with the state. A limited partnership requires a minimum of 2 partners, 1 general partner and at least 1 limited partner. The general partner, GP, is responsible for managing the program and must contribute at least 1% of the program's capital. The limited partner, LP, is a passive investor with no control over managerial decisions. Instead, limited partners are typically the investors who contribute a significant portion of the program's capital. Advantages of limited partnerships. Some of the benefits of this ownership structure include the following. Favorable tax treatment. Subchapter C corporations, often simply referred to as corporations, are taxed twice. Corporations are required to pay taxes on their income, and then their shareholders pay taxes on any dividends that the corporations distribute. Unlike corporations, partnerships are not taxable entities. Instead, the partnership's income or loss is allocated directly to the partners for tax treatment on their personal income tax returns. It has pass-through treatment and is reported as passive. Any passive income that's distributed is taxed as ordinary income. Since the business doesn't pay tax, limited partners may receive more income from a profitable DPP than from a profitable corporation, since a corporation's dividends are paid as after-tax distributions. As is the case with REITs, beginning in 2018, DPP investors receive the following tax benefits. 20% of the income that's passed through by partnerships is deductible, excluded from tax. The maximum tax rate on ordinary income has been lowered to 37% from 39.6%. Limited liability. In return for a share in a project's income and deductions, limited partners assume financial risk only to the extent of their investment. In other words, limited partners cannot lose more than the amount that they have at risk. Diversification. Many limited partnerships invest in assets that have little or no correlation to the stock and bond markets. These programs may provide an investor with a level of diversification that may not be available from traditional mutual fund offerings. Disadvantages of limited partnerships. Some of the drawbacks to this form of investment include the following: lack of control. Limited partners may have no managerial authority regarding the daily business of the partnership. Unlike a traditional corporation, there may be very little, if any, oversight of the management by an independent board of directors. Illiquidity. Since a limited partner's investment is normally unable to be sold quickly, it's an illiquid investment. In most cases, there's no actively traded public market for these investments, and limited partners are often required to obtain the permission of the general partner to sell their interest in the partnership. Tax issues. Owning a limited partnership will likely complicate a client's year-end tax filing. Since many partnerships are constructed in such a way to take advantage of certain benefits that exist in the US tax code, any change in tax laws or adverse IRS rulings could negatively impact a limited partner's future returns. Possible capital call. Unlike the previously described investments, investors in limited partnerships may be asked to contribute additional funds after their initial investment. Failure to make the additional contribution could result in the investors forfeiting their interest in a project. General partners. General partners have unlimited liability and are responsible for all management affairs of the partnership. GPs also assemble investors' capital, collect fees for overseeing the partnership's operations, keep the partnership books, and direct the investment of the partnership's funds. General partners have a fiduciary relationship to the limited partners in these programs. Limited partners. In the simplest terms, limited partners are passive investors who make no day-to-day management decisions. In fact, if limited partners take on an active role in the management of the programs, they may be considered general partners and will have unlimited liability. DPP offering practices. To raise money, the general partner may conduct either a public or private securities offering. In a public offering, the general partner hires an underwriter to market the program to the public and registers the DPP's interests with the SEC. Disclosure is made to investors through an offering prospectus. Although these securities may be registered with the SEC, DPP interests are generally illiquid. If sales are executed by an underwriter, the purchases must be accepted by the general partner to be valid. At times, GPs may themselves act as syndicators, or they may hire an independent investment banker to assist in the distribution. In either case, the maximum underwriting compensation for a public offering is 10% of the gross dollar amount of the securities being sold. In a private placement, the sponsor will attempt to locate investors without the assistance of an underwriter. These types of offerings are conducted under Regulation D of the Securities Act of 1933 and are exempt from registration. In a Reg D offering, disclosure is provided to investors through an offering memorandum. Tax treatment of individual partners. Passive activities. Passive activities are investments in which a business owner doesn't materially participate in its operations. Investments in direct participation programs and rental activities are considered passive activities. Losses generated by passive activities may only be deducted against income from passive activities. If passive losses exceed passive income, the excess passive losses may be carried forward indefinitely to offset passive income in future years. When the ownership interest in a passive activity is sold, the investor can deduct all passive losses that are carried forward against any form of income. Types of limited partnerships. Historically, limited partnerships have been established to allow for investment in a wide variety of assets. The SIE examination will primarily focus on two types of programs: real estate and oil and gas. Let's examine the details of each type. Types of real estate limited partnerships. The primary advantage of investing in real estate is that land is a commodity with a fixed supply but constantly increasing demand. Real estate programs focus on raw land, new construction, existing properties, and government-assisted housing. Raw land. For the purpose of land speculation, limited partnerships may purchase large tracts of raw, undeveloped land. Investments in raw land offer no depreciation deductions and little or no periodic incomes. The motivation is the potential capital appreciation. New construction. Generally, the objective of investing in new construction is capital appreciation. However, there may be some cash flow if properties are leased. A real estate construction program involves a large financial commitment, usually accomplished through leverage. Existing properties. Certain programs are formed primarily to purchase existing commercial properties and apartments. Returns in these programs are predictable and offer a high degree of certainty. For investors in existing property partnerships, two benefits are immediate cash flow from rentals and the availability of depreciation allowances. Government-assisted housing. Government-assisted housing projects are created to provide low-cost housing for low-income families. Most federally subsidized housing programs are part of the Section 8 program administered by the Department of Housing and Urban Development. The costs associated with construction, rehabilitation, or acquisition of low-income housing qualify for tax credits, which is the major benefit. Types of oil and gas limited partnerships. Oil and gas programs are formed for the exploration, drilling, or development of oil and natural gas. Management typically provides the technology and organization. However, it may not specifically identify the areas to be drilled until after the program is created. Exploratory program. Exploratory drilling, also known as wildcatting, involves searching for oil and gas in unproven areas. Due to the uncertainty of success, these programs are considered high-risk ventures. Developmental program. In a developmental program, leases are acquired for the right to drill in proven areas. Although this type of program offers high deductibility, its lower risk equates to a lower potential return than what is provided by a wildcatting program. The reduced risk is based on the belief that a productive exploratory well could be surrounded by equally productive drilling locations. Balance program. A balanced drilling program combines both exploratory and developmental drilling. The exploratory drilling provides the potential for high yields, while the developmental drilling offsets the high risks associated with exploratory drilling. Income program. An income program acquires interest in already producing wells. These well sites are obtained from oil and gas operators who have completed the drilling and chosen to sell the reserves. Since income programs are the most conservative oil and gas offerings, they may be suitable for clients who are somewhat risk-averse. Risk summary. Before investing in a limited partnership, investors should be aware of the various risk components inherent in the program. Some of the risk considerations include management ability of the general partners, illiquid nature of limited partnership units, possible loss of capital and unpredictability of income, ability of the investor to pay any potential future assessments, rising operating costs, availability of good properties or leases, changes in tax laws and government regulations, economic and environmental occurrences. Investor certification. Prior to executing sales, registered representatives must certify that they have informed their customers of all relevant facts. Additionally, RRs must have reasonable grounds to believe that their customers possess sufficient net worth and income to withstand potential losses. Discretionary accounts. Due to the complexity of these products, RRs are not permitted to exercise discretion when recommending a DPP. In other words, a customer's written approval is required before purchase. This concludes the examination of alternative investments. These products have unique features and can be very attractive to various investors. The next segment will examine options contracts, which are a form of derivative investment that can be used to speculate, hedge, or generate income. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. Please turn on your notifications to be among the first to be introduced to the next segment. Thanks.